So I know Beyonce continues to trend all over social media after she went on tour and then she released her movie. But something that Beyoncé and Jay Z did, which was really talked about, was how they got a loan on their $40 million home. This is crazy because you're like, these are multi-million billionaires, but they're getting loans. Tim, why would they get a loan? And let's talk about some of the different loans that are available.
Well, I've never done a loan for 40 million. Those are very specific loans that you have to go to specific places for. But to me, it demonstrates the high acumen for financial literacy and using leverage through real estate. To me, if I'm a home buyer out there, that tells me getting a mortgage, whether it's $300,000 or $35 million, can be the right thing to do. If you've got billions of dollars and you're willing to put leverage on real estate so that you're not using all of your own money in a deal, it's usually the right thing to do. So to me, it comes down to finding the right people to help answer the questions that make sense for your financial situations. I'm sure Beyonce and Jay Z have some of the best, and that's what they advise them. Why would you want to go and spend 40 million of your own money when you can spread that around to other deals that I'm sure they're working on, other debts they might have to pay, other assets they want to acquire? Whether it's 30 million or 300,000, leverage from real estate is always a very powerful thing to use.
Yes, absolutely. And this is really important because we all breathe the same air as Beyonce.
Do we? Do we though?
We do. This is really important for us to know because, back in the day, our grandparents are like, oh, you need to put 20% down on the home and then you need to live in the home forever. And that is not the case nowadays. We are seeing so many more lenders and home buyers talking about how they put 3% down or 5% down, or even sometimes 15% if it's an investment property. But 20% is not this magic number that we all have to abide to.
Yeah, 20% was a gold standard for a long time. And really what that comes from is before FHA was created in the 30s, there was no other option. And when FHA came in and allowed for lower down payments, it allowed you as a home buyer to buy a home with as little as 3.5% down. Don't feel like you have to put 20% down. Anybody who's watching this, if there's anything I could share, don't feel like you have to save your way to 20%, and that's the only way that you'll be able to buy a home. Because I've had clients who walked away from a closing table getting money back, right? So not only did they end up not having to have any money, they got money back at closing. Where there's a will, there's a way. If you've got some money saved, that's always helpful. But there's programs where you can put little to no down payment, like down payment assistance. And if you have a whole bunch of money saved and you want to put 20% down and it doesn't impact your financial stability, God bless. I'm not saying don't do it, but especially for those first-time home buyers that are out there, don't feel like you have to save your way to 20%. Because in the end, it won't make that big a difference for you and what you'll be able to be approved for and whether or not you'll qualify.
That's perfect. And one thing that I'm really passionate about is helping homeowners sell their homes. And a lot of times it's in that, $800,000 to $2.5 million.
Yeah.
And so in this range, we are seeing a lot of these sellers offering concessions to the buyers to close on the property. And so right now, buyers, they're a little kind of frantic because of interest rates. But imagine if the seller of the property gave you basically money to close on the deal, and they said, hey, here is a credit that you can use for a buydown, like a 2-1 buydown or a 3-2-1 buydown. And hold up, I know you're probably thinking 2-1, 3-2-1, are we in kindergarten talking about numbers? But I'm going to have Tim break down what a 2-1 buydown is and a 3-2-1 buydown and how this can really impact what your monthly payment is going to be.
Very simply, a 2-1 buydown or a 3-2-1 buydown are referred to as temporary buydowns. In a 2-1 buydown, what that means is you have 2 years before your rate stays the same, if you will, right? So in a 2-1 buydown, the first year of having the loan, your interest rate will be 2% lower than whatever you qualify at. So for example, if you're buying a $600,000 house and you're putting 5% down, let's just say rates are 7%, but you want to do a 2-1 buy down. The first year, the rate will be 5%, 2% lower. Year 2, it'll be 1% lower. And then in the third year, it'll lock in at that 7%, and it'll be that for the rest of the loan.
Wait. But until you're able to.
If rates change, right, which, listen, I'll never be the guy who says rates have to go down.
Right.
The expectation is they will go down. We're at 20-plus year highs. Inflation has been high. As inflation comes down and some things change in the economy, rates should come down. And when they do, you should be able to refinance that house. So let's say rates do come down to 5%. Well, then you may be able to lock the money in at 5% instead of waiting for it to change, that 2-1 buy down to change to 7. The important part of the buy down is in that example, in a $600,000 house with a 2-1 buy down, year 1, it would save you over $700 a month. Wow, that's a huge difference in payment and creates a ton of affordability. You may be able to buy a house that maybe is a little bit more than what you wanted to, but it becomes affordable because you're saving $700 or so the first year, a little over $350 the second year, and you've got a full 24 payments before you get to that 7% interest rate payment.
Okay, perfect.
That's huge. Literally, if you are a home buyer out there and you're shopping, if you're not asking your lender and your agent about buy downs, you're missing out. Again, there's no program that's right for everybody, but make sure you're asking these questions because you want to have the information to make the best decision for you and your family.
Another thing that's really cool about Buydowns, as a buyer, this is not something that you're paying for. This is literally the seller who is paying for this. And if you're a buyer right now and you're like, oh, well, I'll just do a 2-1 buy down and you pay for it, that's not possible. The only way you can do a 3-2-1 buy down or a 2-1 buy down is if the seller pays for it.
Yeah, so essentially the lower payment is paid for by the money that the seller credits you. And they fractionalize it, if you will. They'll take the first year at 1/12 and the second year at 1/12. That's where you save that money, right? So let's just say it's about $13,000 in concessions to do the 2-1 buy down. A portion of that will come off of that credit it actually stays in an escrow account for the 2 years you have that buy down. And if you refinance within 2 years, not only did you get the concession up front to have the lower payment for the first 2 years, but when you go to refinance, that any money that's left over from there gets applied to your balance, which is a huge bonus in my opinion. That way the balance you go to refinance would be a little bit lower, helping your payment be a little bit more affordable with lower rates.
Okay, this is good. I hope you wrote this one down, and when you're looking to buy, make sure you have this conversation with your realtor, but most importantly, with a lender.
I was going to say, the more concessions you can get, the more creative you can get. Whether you do a 2-1 buy down or what's referred to as a permanent buy down, and that's where, again, let's just say, for example, say rates are 7, you get a concession and you buy the rate down to 6, and it just stays at 6 forever, right? That might be all you need to make it affordable. With a 3-2-1 buy down, it's similar, except instead of starting, if your rate's 7 on a 3-2-1, year 1 your rate would start at 4%, right? So it's even more of a payment savings for you getting into a home. And we all know the first year of homeownership, there's a lot of surprises that happen.
Oh, I know. Right? It's been expensive.
Right? As a lender, I do my best to consult about reminding people about the dishes, the curtains, the floor mats, silverware, all the expenses you may incur in that first year of homeownership.
I'm talking about the furniture.
Yeah,
you know how much a couch costs?
all those things, right? It adds up. So
Yeah.
a 2-1 and a 3-2-1 buy down can really alleviate some of the monthly expense, so you can, live a little bit more comfortably.
Yeah.
And then the idea is hopefully rates do subside over the next year, few years, you can refinance, lower your payment, lock it in, and rest is history, as they would say.
Yeah. This is super important. And the other thing that I really like to talk to our clients about is, say they're shopping around